Elon Musk has not really been characterized as somebody who sandbags a lot, but from time to time, there are situations where there might be some sandbagging going on. Larry Goldberg, a frequent guest and co-host on this channel, has a theory that maybe there's some sandbagging going on in the supercharger business. And I'm thinking that at least part of what Larry is saying is 100% right. Larry Goldberg, glad to have you back as always.
Thank you, Randy. Good to be here.
So I think the most famous incidents of him sandbagging has been on Starlink. He kept on saying over and over again that this was only going to be for the remote areas, and he didn't really care about anybody in the cities or anything else. And now, not only do we have the remote areas, we have the cities, we have backpack levels, a new version coming out of this of the what do you call the darn panel that
The
receives
dish.
the dish? We have a new version of the dish coming out that'll be backpack sized. So I'm beginning to think maybe there was some sandbagging going on there. And you think maybe his theory that he's only going to make 25% on supercharging, maybe a little sandbagging going on there as well.
Yeah, I think that his 25% is a fully loaded 25% with SG&A, spread across it as well. But in our book, it's pure margin because that the SG&A applicable to the supercharging network is very, very contained. It's I won't say it's trivial. It probably is, but it's probably significantly lower than SG&A in the rest of the business. So
Right.
it could well be as low as 25% fully loaded. What I'm looking at is gross margin and its contribution,
Right.
because the SG&A is from our perspective, when we get it in the financials, it's a fixed amount of money, and then the gross margin just it comes in to whatever it is. So we're looking at gross margin. That's the one thing I'll tell you. The other is it's a very healthy amount of money, and that's really what I'm going to show you.
All right. Well, you want to show your screen or share your
Sure,
screen, and we'll take a look at your number.
sure. We'll have a look at it. Uh, Tell me when you can see it.
I'll let you know.
It should be going now.
I think it is. There we go.
Okay, good. So, um, what we're looking at here is the charging revenue and all other services revenue and the total services revenue, just to orient you. So the little blue bar is, just the charging revenue. This orange bar is the charging, is all other services, and the gray bar is the total of the two.
Right. And by all
And
of by all of the services, we're talking about a resale of used cars after they come off lease. We're talking about the service centers where they're doing everything from collision repair to maintenance and such as that. We're talking about, did I say insurance already? We were talking about all kinds of these. Oh, we'd be talking about the revenues from the $10 a month for the subscription on your uh,
right,
in the car in car service SaaS. That would also be included. So we have
yes,
all kinds of these little service things that all add up to a lot of money.
right. And it started in 2019. Back in 2019, it was just above the 2 billion mark. And that was, the Y had been introduced, and we had all four cars on the road. We had Shanghai underway. So, the business had coalesced into really the shape of the business at this time. Texas wasn't open yet, and Berlin wasn't open yet, but at least all the models were out there. So the one thing this doesn't incorporate, of course, is warranty, the warranty reserve, because the warranty reserve comes straight out of the gross margin for cars.
Uh-huh.
So, when the gross margin is calculated, there's a reserve for warranty, and I have all these slides that show that we're over reserving for warranty by a very significant amount of money. Probably a good 1% of gross margin is being
Wow.
taken up by over provision on the warranty. But it's a new company, it's a new technology, blah, 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 and they're being very cautious. But that money is really piling up. And, we've talked about that in the past
We have, yeah.
together, and I have a whole presentation on that. But anyway, so this just gives you an idea that, the charging revenue, which was relatively static in 2019 and 2020, started growing really nicely in 21, 22, and 23. And I'll focus in on that. But the services revenue has been growing very nicely. I mean, it's been really, a steep curve up to now. So that's a healthy business. Overall, it's a healthy business. And if you look at the supercharger network, it's a very healthy business. If you isolate just the P&L for the services, and again, it's gross margin before the deduction for overhead, but in 2019, on a revenue of about 300 million, we were making about 71 million. Yeah. And we've been climbing, fairly gradually. 2020 was not much better, but 2021 saw a big rise. And these are my estimates. Tesla don't publish this,
Right.
but I figured that we earned about 258 million in 2021. It almost doubled in 2022. It was a big jump in utilization in 2022.
Mm-hmm.
And 2023, I'm at around 650 million of profit.
Right.
And these are important numbers, because if you compare this to where we are for the whole of services, you'll see that, charging is a very significant number in terms of profitability, because this is the profit and loss. This is the profit on charging, and
Yes.
this is the loss on services.
Overall, yeah.
So it just gives you a sense of, the importance of services. You'll see how services charging rises, and that offsets a lot of the loss of services. By 2021, the charging profit offsets the services loss to the point that actually, on balance, the whole of services makes a profit.
Right.
And in 2022, services doubles its profit, as does charging.
Right.
And in 2023, services is earning a healthy profit overall, but still less than the contribution.
Right. Right.
Now, at a point in time, and it's probably 2024 that it happens if the business continues well, services themselves will be making money, and that will really grow the business. So all of those maintenance depots out there, all those service centers, they're really being paid for by these costs, and I think the supercharging network is offsetting a very significant portion of that cost.
Yeah.
Spoke about insurance. Insurance takes a while to build what we call the long tail.
Mm-hmm.
It takes a while to build the investment fund up to where it can actually start making a profit. That's the thing about insurance companies. They take a long time to become profitable, and when they become profitable, they just keep rolling,
Right.
because that's the nature of the business. So we're only beginning to see that now. But the truth is that supercharging has been a very, very good business, and it's really helped solve the cost of services. Now, this doesn't include the warranty repairs. The warranty repairs come straight out of gross profit.
Right.
So the gross profit of the auto business is offset by partially offset by the amount set aside for warranty. And I have a, I follow the warranty very carefully, and I can tell you that there's a very significant over reserving for warranty, but that's a story for another day. So the summary, if you look at the whole of the services business, here is the story. Here is, our cost is in the orange line. The blue is the revenue line for all of services, and this includes the supercharging.
Right.
And this is the profit and loss break-even line, $0 here.
Mm-hmm.
And here, this is the profit side of the equation. You'll see that our loss was $544 million. That was $500 million in 2019. $333 million in 2020. Only $104 million in 2021.
Loss. Mm-hmm.
You lost, but then we hit this profit level. We sort of broke through, and with significant support from the supercharger network, made a profit of 211,000, and now it's getting to $600 million. Million dollars. It's becoming a meaningful amount of money. 583 million profit.
So Larry, so that's where we are today. But the real interesting thing I think about the charging network is that there's a lot of changes going on. So one of those changes would be that now we're going to invite other people in. So as we're inviting other people in, that should make the efficiency go up. That we should be having the stations being used a higher percentage of the time, which should be a contribution to profit. I know that Elon, I believe anyway, that Elon intends to put canopies with solar roofs on those canopies, probably on every possible station. And
I would just tell you that that's not necessarily the strategy.
Okay.
The strategy is to offset the use of electricity with solar.
Mm-hmm.
It's not necessarily the most efficient method of using solar by just putting roofs over the chargers, because that's probably not sufficient that's not sufficient energy to offset the use of the charger.
Uh-huh.
So it's better for them to site their solar farms on larger pieces of land.
I see.
Rather than in directly in the same property as the chargers. Now, having said that, I mean, I've been to charging stations where they do have solar.
Right.
There's some very large charging stations with 50, 100 posts, and there they will have a lot of solar, and that kind of works. But when you have 4 posts or 8 posts or 16 posts, as a very large number of these stations are, they're not going to have solar. Mm-hmm. What they're going to have is a solar farm somewhere in the
area,
somewhere in the area that's going to offset all the use in the sort of geography that the chargers are in. Does that make sense?
Yes, but ultimately the idea would be between the use of solar charging and the use of batteries, mega chargers are smaller mega packs, possibly are power walls. One way or the other, they would intend to eventually have almost free energy, which should allow them to either be really competitive or allow them to be very profitable. One of the two.
Right. I don't think, from everything I've seen here in Europe, I don't think competition is a factor yet.
Not yet. Yeah, but someday it could.
Yeah, I don't know. I don't know whether it'll ever come. But having said that, I mean, I think their margins are very healthy. Now, I could be wrong. I mean, this is all tea leaf reading, and I could be wrong.
Right.
But from all the leaves that I read, I think the contribution is very, very significant.
And so then the next question would become the future. So we've got the growth rate. I think you've got some charts on the growth rate, and maybe we can extrapolate from that to get some idea of what the numbers could be in the future.
Well, the growth rate is actually very easy to see from the dollars, actually,
Yeah.
because, the dollars on the growth have been very, very, very significant. I mean, if you just look at the, let's go back to this. Just look at the charging revenue.
Right.
I mean, ever since 2020, it's been like, I mean, I think we're getting to an almost exponential curve.
Right.
So where are we going from here? So the actual number of posts that have gone into the ground in the last 2 years have been almost the same month over month or quarter over quarter. And I think that's because the factory's churning them out, and the rate at which the factory's churning them out seems to be, static at this point. So until they add another factory or expand the factories in which they're manufacturing these posts, we're kind of constrained to this rate of growth. But there are two factors in the rate of growth. The one is the number of posts that they put in, and the second is the utilization.
Right.
And the rate that they charge. Now, it's no secret that the last 2 years, the rate has gone up very dramatically. So they're now charging really full freight on the power. So that's made a big impact, a very big impact. So I think we're going to see this rate of growth, this almost 50% rise. I mean, it's running at close to 50% rise, maybe 40% rise. I think we're going to see that continue for another couple of years.
Okay. So if we're at $1 billion in revenue in 2023, roughly.
Well, no, it's more than that. It's $1.25 billion. $1.25 billion.
Okay, $1.25 billion. So if we continue to increase at 50% a year, that's pretty soon that would turn into real money.
Yeah, I mean, if you go out to 2030, I think that I forecast this at about a somewhere between $6 and $8 billion business.
Okay.
And I think it may even touch $10 billion in the 2030 year itself.
Got it.
And at this very, very significant margin. So the margins, as you can see, are, in the 40% gross range.
Right.
So that 40% gross margin range, $10 billion business is $4 billion profit. Well, that's 80 cents a share. So it's not bupkis.
Right. Not at all. It's serious money. All right. So anything left in your presentation? No, that's okay.
That's it.
All right. So charging is potentially a very big business. Well, it's going to be a big business. There's no doubt about that. The question is, how big will it be? And that's going to be potentially a product of whether they add factories or add capacity in the factories they have. I think that both of those are very likely because if they're going to open the charging to other brands, which they are, and if they are going to be increasing their numbers to the point where they're making 4, 6, 10, 20 million cars a year, they're going to need massive numbers of additional chargers in order to support that group.
Right. And the other thing is they are selling these chargers now.
Right. That's true.
So they did the deal with BP. I do believe they're probably selling the chargers, to the likes of Ford as well. So right. I think there's going to be a significant, and don't forget, the big bump comes when the Semi comes on the road. That's going to be a massive bump. The margins are going to be much lighter because, for the most part, those very large chargers are going to be run by the customers, and they're going to buy the chargers.
Yep.
And I don't know if there's going to be a royalty or there's going to be some service agreement, but obviously there will be some revenue. But there will be an upfront sale of these massive charges and then some sort of maintenance and so on. So the business becomes very interesting once the Semi goes on the road, because even the chargers that the Semi chargers that they do install at their charging stations are going to have massive throughput,
right,
compared to these small posts.
Right. Yep.
and so it's going to be significant. And so I think that this business is only going to grow at a faster and faster pace, and probably will outstrip my projections.
Yeah, I think you're right. I think that that is again, because they now have this CATL thing. I mean, not CATL, the North American Charging Standard becoming the standard for everybody, and meaning all these other cars will be able to use the stations. I think that they'll have to. They'll just. It won't be a question of will they. It'll be a question of we have to.
Right,
Right.
right. And
Larry?
they are contracted to build a whole bunch of stations for the US federal program as well,
Right.
which
Right.
is taking its time to get off the ground. But
Yeah,
anyway,
that's true. Yeah.
yeah.
Larry, as always, thank you for
Thank
bringing
you.
something that nobody else is talking about. This is a significant business, and basically you're the guy that's following it. And we appreciate you, as always, being the one who brings special stuff that nobody else is talking about. All right. So to all of you out there, it has been great talking to you.